Welcome to Martin and Friends, Carbon Black Asia with Paul Ita from Notch Consulting and Shane Paul from Alpen Group discussing carbon black trends in Asia.
Hey Paul, hey Shane, hello, how are you guys?
Hi. Good, Martin, good afternoon.
It's great having you for webinar Carbon Black Asia. Welcome, dear participants. Today we will have 3 presentations from 3 world carbon black experts. Paul will present about supply, demand and pricing of carbon black in Asia. Shane will present about feedstocks and new sustainable feedstocks. And I will present about industry and segment mapping of carbon black. And I will also give an update about recovered carbon black. Thank you for attending the webinar. So, Paul, you're the gold standard for any intelligence in the carbon black industry. So I'm very happy that you can present today. Over to you.
Great, thank you, Martin. Well, thanks to Martin for organizing this, and thanks to Shane for participating. I hope it's the first of many webinars and the way we can talk directly to customers. I'm really excited about this. So yeah, I'm Paul Ita of Notch Consulting. I published the Carbon Black World Data Book, and I'm here to talk today about Asia carbon black supply and demand. And I'm just going to go over sort of a big picture view of what's been going on in Asia for the last couple of years and through the COVID crisis. So my first slide here shows carbon black capacity and production by quarter from the beginning of 2017 through the end of 2020. I want to point out that Q4 2020 is still preliminary, so that data is still being finalized. But obviously what jumps out, I think, at everyone here is the effect of the COVID crisis here in 2020. But I actually wanted to go back to 2019 as well and just say how, in my analysis, I've been comparing 2020 to 2019 just to give a sort of ballpark figure of where the market is. But 2019 was hardly a banner year for the industry. So we're sort of comparing it to a fairly mediocre year at the beginning. And part of that was an increase in capacity here, as you can see, but also production was fairly lackluster, which is this blue segment. And as you can see, utilization was pretty flat across the board and down from where it had been the previous couple of years. And again, here, the green and blue segments are production and capacity on the left scale, and the red line is utilization on the right scale. And utilization is just production as a share of capacity. But then as we come into the first quarter of 2020, you can see here the very dramatic effect of the COVID shutdowns. This actually was mainly China, which really got hit by the crisis first, and in particular in January and February, but particularly February. And then the second quarter was really when the COVID crisis spread to the rest of Asia. But it actually, production went up, and mainly that's due to China's recovery. By the second quarter was actually pretty robust. So that's sort of masking an overall weakness across the region, that China was kind of growing and the rest of the region was kind of shutting down at the same time. And we'll see that very starkly later in some of the export data that I collected for y'all. But you can see there, as the second half of the year came on, it was significantly stronger results. And just to give a quarter by quarter figure, this represents a decline of about 20% overall, and then about 8% growth in the second quarter and 15% in the third quarter. So as I was mentioning earlier, here's a look at exports of some of the leading Asian carbon black exporters. And you can see there that nearly across the board, we're in pretty strong negative numbers for exports for 20. This compares 2020 to 2019. And this is full year data for all of these countries except for India, which is 11 months year to date. But you can see that except for the Korea, all of the major exporters are down fairly significantly, with China down. China, the largest exporter of carbon black, both in Asia and the world, is down 17%. And for China, that really reflects reduced exports to India in particular, as well as Thailand, Indonesia, and Japan and Malaysia. But exports were up actually to Vietnam and Taiwan. So there were some bright spots, but they were vastly overshadowed by pretty steep reductions to almost all of the major export markets for China carbon black. Now, Korea is an interesting case here because some of the increase here is actually some of the same countries that China saw declines in. So for Korea, there was increased exports to Thailand, Vietnam, and Malaysia, as well as Indonesia and China. So I'm going to talk in another slide about some of the shifts in, I think, pricing and valuation that occurred due to feedstocks that is partly responsible, I think, for this sort of contrary performance between Korea and China over the last 12 months or so. And then you can see here for the other major exporters that, down 7% for India, 11% for Thailand, and 10% for Japan, and 4% for Taiwan. So across the board, a pretty negative year overall for carbon black exports. So to take a sort of a specific look at China month by month, this looks at China exports in terms of volume from January 2019 through December 2020. And you can see there again the very stark effect of COVID. And interestingly, for China, really the worst of the COVID crisis was February by far. But that didn't really affect exports. That was really their domestic market. It wasn't until April and May, when the COVID shutdowns sort of spread to the rest of Asia, that Chinese exports really took a hit there. And they bottomed out there in May of 2020 and then began a pretty robust recovery through late summer and then kind of planed off at about 65,000 tons per month, which is not quite where it was back in these peak years, but certainly more healthy than it was during the worst of the COVID crisis. And I just wanted to point out that this issue here in April and May, I was looking at the month-to-month data, and it looks like exports to Thailand were down about 75% in May. Vietnam was down about 40%, and Indonesia down about 70%. So you can see there that collectively that had led to a pretty steep decline in Chinese exports overall. So this slide looks at the other leading exporters of carbon black in the Asia region, Korea, India, and Thailand, who are the leaders volume-wise in terms of exports. And you can see there, though it's a little bit muddled here, but you can see clearly the same pattern that we just saw in China, which is, for Korea, where it's very clean, exactly the same pattern of reduced exports in April and May, and then a recovery through the second half of the year with some unevenness here. But in general, Korea has come out with much stronger exports over the second half of the year. And then India, you can see it saw that decline a month earlier in April and then recovered and then had another weak month. So, and then Thailand really following basically the same pattern as Korea in terms of the reduction. But for all these countries, there was a nice recovery over the second half of the year, a little bit less so in India and Thailand and a little more so in Korea. And then just a quick look at pricing or overall valuation of carbon black exports. And you can see here that China, which is this blue line, had a very clear price advantage coming into the crisis over all these other three suppliers. So this is exports in terms of value by China, India, Korea, and Thailand. And you can see there the very clear price advantage that China held through, say, early 2020 when the crude oil price really dropped. And you can see there the shift between coal tar feedstocks and decant oil beginning to have an effect on carbon black pricing, as both Korea and India, and to a lesser extent Thailand, all came within pretty close parity to China export prices there as by late summer. And since then we've seen go ahead, sorry.
Well, I don't mean to interrupt, but I know we were viewing this as a bit of a conversation. So if you don't mind me asking you a question, are these, just to help me get a feel for it, are these FOB prices, or are these the prices of the receiving country? Is it FOB at the country?
These are FOB prices.
Okay, I was curious if it included different taxes and duties and whatnot.
Right. Yeah.
what
No,
impact
this would
that-
exclude taxes and duties, so it should be pretty directly comparable.
Okay.
Yeah. But you can see there that I think part of the reason, there's probably a couple of reasons that Korea had a stronger year export wise. One is a sort of a being priced more in parity with Chinese exports, which had been the price leader, and the second one has more to do with capacity, which I didn't really put in the presentation. But there has been a significant increase in Korean capacity through the HOCI. Joint venture, which added 100,000 tons of capacity. So I think that the Korean market will probably the Korean industry will be more export oriented as we go forward. And I think that trend will probably continue, of Korea rising in prominence as a regional exporter. So this one, just to sort of finish up the foreign trade picture, is imports of leading Asian countries in terms of volume, comparing 2020 to 2019. And you can see there that for some of the leaders, the numbers are pretty consistent, down 20% for Indonesia, 18% for India, 20% for Japan. Thailand, which is the largest importer in Asia, was only down about 4%. For some of these countries, that, like for India in particular and Thailand, some of that reflected a shifting between import dependence. In other words, I think they relied a little bit more on domestic supply than they had in the previous year. I'm not sure if those trends will continue, but at least for 2020, that held true. And then the big standout here for me is Vietnam, which was up 11%. And amongst all the countries here, I think Vietnam's interesting because it has no domestic capacity. So all of the domestic requirements are imported. So that increase of 11% really was reflective of a stronger localized demand and actually increased production. So that's one of the few countries around that I've seen that actually saw volumes increase significantly over the course of 2020. China, by contrast, also saw its imports up 15%. But it's important to remember that China imports really a pretty specialized slate of carbon blacks. A lot of higher priced premium grades and a lot of specialty grades. And just by way of comparison, these imports for Vietnam represent 100% of Vietnamese carbon black demand, whereas for China, this amount of imports, which is about 86,000 tons, is only about 2% of their total domestic demand. So it's really a drop in the bucket in terms of overall market growth. And then you can see here for the rest of the suppliers, it was just sort of a middling year, up a little bit in Taiwan and Korea, and down a little bit in Malaysia and Sri Lanka. And I also did want to point out that for both Vietnam and Sri Lanka, these are derived imports. In other words, these are reported exports of people exporting into Vietnam and Sri Lanka, because they have not reported that data independently, at least that I can acquire. And again, this is all full year data for 2020, except for Malaysia and India, which are both 11 months year to date. So just to take a look at a forecast for carbon black in Asia. So this shows Asian carbon black annual capacity and production forecast from 2009 through 2024. And you can see there really a very classic V-shaped downturn in recovery. Again, just trying to point out that for Asia, at least, the last few years, 17, 18, 19, prior to COVID, were sort of difficult years, mainly due to the fact that, as you can see here, there was a pretty significant increase in capacity, while at the same time production was relatively flat. I mean, I think there was a little bit of growth, but not much. And that led to this pretty steep decline in utilization from about 80% in 2017 down to about 76% in 18, and then down to the low 70s by 19. And then, of course, COVID came along and drove that down to 66, 67%, which was obviously a difficult situation. And then looking forward, we are forecasting 11.5 million tons of capacity in 2020 and production of about 7.6 million tons, and then moving up to almost about 13.1 million tons of capacity in 2024, and production just above 10.5, about 10.6 million tons. So a nice recovery back up to utilization rates that were the norm back over here of the high 70s to 80. And then my final slide here is a look at what I've been doing since the COVID crisis broke, was taking a look at different scenarios for forecasting demand. Now, and again, this is not Asia, this is the world, this is world forecast. But this shows my initial best case and worst case scenarios. My initial best case and worst case scenarios, which is the blue line and the yellow line here. And then the actual forecast as it came out, and then as I'm forecasting going forward. And as you can see here, the current forecast for 2020 is actually very, very close to the best case scenario. So as I've gone through these revisions, it's been steadily improving each time I look at the rubber data for a new quarter. So that was really due to two factors. One was I think the downturn was not as steep as I had originally forecast. It looked like there was a little bit more hidden demand out there than what I had forecast. And also the duration of the downturn was more limited than I thought. I had been expecting it to be through the entire quarter, but it really was more localized to about 8 weeks for about the worst of the downturn, which was, again, February for China, and January, February for China, and then April, May for most of the rest of the region. And then if you look forward, the forecast, this is my pre-COVID forecast here, this green line. And if you look, we're probably back to the pre-COVID forecast by, say, 2023 or 2024 at the latest. So all in all, a fairly robust recovery coming out of the COVID crisis, fingers crossed, and all things being equal. So that's the end of my presentation. If you have any questions, I understand we're going to answer those in writing afterwards.
Thank you, Paul, for the presentation. The one thing that I noticed is the V-shaped recovery, and I wonder what kind of influence that had on the pricing. We'll hear from Shane later on about feedstock and feedstock disruptions, but what can you tell us about what happened in the recovery phase in the pricing in Asia?
That's a great question. I think that it's been a challenging year across the board, and I think that pricing has reflected that. There has been a slight recovery, and I think Shane will talk about this maybe in the second half of the year in terms of both coal tar and decant oil. So I think prices have come up. I know that for contracting, which is sort of a bigger factor in Europe and North America, it was definitely a very, very challenging year, and I think contracts dragged out to an extent that I had not seen in a long time. In other words, like we were coming into the Christmas season and contracts were still not closed, which is very unusual. And I think for North America, pricing overall was pretty flat for contracts, and in Europe there might have been a slight increase. Europe actually, as you know, I'm sure, Martin, the third quarter and particularly the fourth quarter were actually quite strong in Europe, which surprised me, and I think surprised a lot of people. I think people were caught a little bit unprepared for the level of demand that came out in the fourth quarter. And I think that was true also in Asia overall. Like I said, my fourth quarter numbers are still preliminary, so I can't put an exact number on that. But anecdotally, from talking to suppliers, it looks as though the fourth quarter was much stronger than people expected. And China may actually be very close to be on parity 2020 to 2019, which if you had told me that back in terms of volume, if you had told me that back in April or May, I would have thought that was not feasible. But so I think that's been reflected in the pricing, that I think people were pleasantly surprised at coming into the fourth quarter that it was stronger than expected. So hopefully that'll go a long way towards supporting price increases.
Do you have any quote of Asian rubber, tire, or carbon black companies? I remember in Europe, the back then CEO of Conti said that actually in a message to the carbon black industry that probably the quarter four will not be as high demand as quarter three, which was like the V-shaped recovery. And it was damping the hopes of the carbon black industry for further price increases.
Yeah, I saw that too. I also was noticing that if you look across the board for most of the big tire companies, they all were revising their annual results upwards. So I do think that I got sort of mixed messages there. I think part of the issue, and you guys can probably talk about this as well, is part of this issue is separate from the carbon black industry, which is I just think that as we came into the fourth quarter of 2020, the supply chain worldwide, I'm not just talking about tires or auto or anything. The whole supply chain was so out of whack. We just kept hearing stories about, shipping containers sitting empty in the wrong location and the price of freight to Asia or from Asia skyrocketing. As we've come into a situation where the automotive industry has this global supply chain and one part can cause a shutdown, I just think the whole supply demand situation has been in flux. So I think what we need to see is a nice steady recovery where all the parts are sort of moving in tandem with each other. I think that'll be the thing. And I think Shane can probably talk about this too, but it's obviously had a huge effect on crude oil and sort of the demand for different types of fuel that is causing, refineries to either run at reduced rates or shift their slate of products, all of which has an effect on carbon black feedstock and availability and quality. And I just think it's just such an unprecedented year that I think sometimes it's difficult to separate, what's affecting carbon black versus what's affecting all manufacturing or all chemicals. So it's been a tough year.
I'll touch on the crude to fuel oil type impact and COVID and IMO and other factors that draw that in. And Paul, one other question I had was, we talked about this when the three of us were doing our preparation was, hey, we all have these points of contact and data and everything looks to a steady recovery and but it doesn't correlate with our gut feelings of no traffic on the roads. If you look at carbon black and what 70% of the demand comes from the tire market and 2/3 of tires are miles driven, 1/3 OEM. Yet all of us look at our traffic maps or drive into our closest city, whether it's Boston, New York, or Berlin, and I'm just not feeling the traffic. And I know that's everyone I talk to more or less has that same sentiment in their stomach. Yet data and everything else and people we talk to say, hey, carbon black's going pretty strong. Yeah. So is there any explanation on what we see in traffic maps and our gut versus true data?
It's a struggle. And I think we admitted this when we talked. I've rarely seen such a disconnect for me between what I think on paper demand should be and what I'm hearing from suppliers. And that was one of the reasons, as I just mentioned, that I was a little bit surprised that the fourth quarter in Europe was so robust. And world, I would include Asia in there as well, because just like you're saying, I was not seeing it on a just out my window basis. I personally canceled 4 or 5 trips this year between business and personal, several of which would have involved driving, long distances, which is what I typically would do over the summertime, and none of those trips happened. So, and that when I talk to family, that seems to, or friends or family or colleagues, that seems to be universal, like you're saying, like everybody sort of said, yeah, we were going to go, we didn't go. So I'm struggling a little bit with that. I can only say I think that part of that is part of what we saw in terms of a scramble for product might have been less. Definitely the demand went up, but I think also what we were seeing were some of these supply situation where people didn't have product on hand. They had difficulty getting trucks across the border. They had problems with getting feedstock. There was just a lot of things that caused shortages that in a normal year should not. And then if we add into that something you may talk about, which is in North America, we just had really an unprecedented year for weather between a very bad hurricane season on the Gulf Coast and then now a really difficult winter, that we just had some really unusual situations that have caused shortages that may not be directly on paper. It looked like there was plenty of capacity, but the issue always is, can I get product to your plant on schedule? And I think it's the second piece that caused more of the supply panic than the piece on paper, if that makes sense.
Okay. Yeah.
Great. Should we move on?
Yes, let's move on. And we'll have Shane. Shane, you are the global leading consultant on the carbon black oil feedstock chain. Very glad that you can present us about the value chain and current trends and developments in carbon black oil.
Well, certainly. Thank you, Martin. Thank you for having me. And yeah, I think it's a good opportunity for us to, obviously by conditions we wish never existed, but we're here because of COVID, and we're doing webinars and mastering the art of speaking into a camera. But with that, I'll put my presentation up and go from there. Okay, so my presentation is going to be a carbon black feedstock update on a global basis with a focus on Asia and different trends and what their impacts are in that realm. What I plan on covering is a bit of an introduction to myself and my company. There's some slides in here that are also just a bit more detailed should you have this presentation in front of you and you want to know what I do. The second part, the Carbon Black Feedstock 101, I generally assume, Paul's the keynote speaker at most events, so there's a lot of people that might be here where feedstock is ancillary for them. So I always like to bring it back to the base level so that when I talk about what's happening in the sections 3 and 4 for what the feedstocks are, what they're priced, and what those different industry trends impact them. So point 3, I'll go through the market, the macroeconomic impacts, IMO, COVID, other factors, supply chain models changing for some feedstock supply, and go on the overall impact of what that is to the Asia Pacific area. And then I think we have a very large trend coming at us, call it maybe a mega trend that's hitting the petrochemical and everywhere. And this is the sustainable future. You have companies, calling it chem cycle, the green cycle, and all those different factors. And I'll talk about where that touches the carbon black feedstock side of things and that area. So Alpen Group, we focus in on all things carbon black feedstock. My background is in the carbon black industry for a handful of years, as well as with BASF for nearly 15, and been out on my own doing the consulting in this realm since 2013. So it's been a good 8 years and continuing on. Like I said, this is more or less, if you have the presentation in front of you, you can see my background and more things there. But I thought it would be interesting just to focus a quick highlight on some of the projects I manage and do for different companies, regional feedstock research, what supply demand trends in different regions, looking at biomass, and I'll touch onto this in my sustainable aspect. What are different mechanisms and processes and materials that can be used as a base for carbon black feedstock? Number 2 and number 5, I think those are interesting there. Just went through a whole IMO 2020 and all industry trends coming at us. I also supply a lot of market information and helping people understand trade flows and pricing and how that what it means for them on the buy side or sell side, and have helped companies with value creation projects in support of JVs, whether it's with a feedstock supplier and a carbon black company, all different areas. So enough about me. I'll jump into it. Carbon Black Feedstock 101. I always think it's good to start and come back to the base level and draw out the carbon black feedstock value chain, and then point out where I think I'm focused and where I am, and from the oils, starting here at the bottom of the page, straight through to the carbon black applications. So my presentation is going to focus in on those bottom 2 layers primarily, and that's the coal tar products coming from a byproduct of the steel production industry, ethylene bottoms from a naphtha cracker, and decant oil coming out of the FCC unit in refineries. And I'll also touch on pyrolysis oil coming from recycling of tires. So a quick 101, decant oil, I went through this portion where each one is from. I think it's also good not to necessarily go through all this in this presentation, but it's a good reference as the attendees will have this presentation in the future for them to have this base level information in front of them. If I were to say what a key trend or driver in how the markets behave is this fourth line down, the output percentage of a different unit that is the material that we as an industry turn around and use as a feedstock. And 2 out of the 3 main industries in which we buy from, it's more or less viewed as a waste product, which really derives the commercial and quality interactions you have with that supply base. And that's on the refineries and the crackers. And then on the coal tar side, it's 35% of their output is used for carbon black feedstock. And to some degree, the carbon black industry can be a complete competitor to the coal tar industry because we can consume their raw materials directly as a feedstock. Dominant regions, the U.S. With 100 FCCs on the decant oil is the overriding material there, and this will come out in trade routes in future discussion points here. And then here's some pros and cons of each one on a yield basis, overall, what the emissions profiles are and where each of the materials is viewed as primarily available. So if we look at how these feedstocks are priced, you have to come back and say we are, as a carbon black industry, we're a price taker because the pricing mechanisms are all set on fuel oil. And the fuel oil, if you look at this chart here, is primarily driven by bunker at roughly half the pool, and the carbon black industry is 7% of it. So as a carbon black feedstock consuming industry, we receive the pricing of a fuel oil, and these are all the indices that we're familiar with, but it's really set by what's happening in the bunker market, and that's IMO and other things. So having that base level knowledge, we then look at what the pricing formula is, and this is the fuel oil price. And I just put an example in here. When we start with the indice, where do you get to the actual end landed cost of your carbon black feedstock? So what you have is your fuel oil price, which is the area that we're the price taker of. And this is the, Platts, US Gulf Coast, it used to be called now the high sulfur fuel oil, or the Northwest Europe, 1% or 3.5. And then you have MOPS for Asia. Those are your different indices here in the fuel oil side of things. This premium or discount is the material pricing mechanism relative to that indice. And I'll talk about this as we go forward here in this presentation. But this piece, to give you an example, is the US Gulf Coast decant oil. Up until about 2014 was always negative. It shifted to positive and it's gone through different periods of fluctuation, but right now we're at a peak that the industry's never seen, where we're in, for US Gulf Coast decant oil, which is a primary feeder for Asian feedstocks, is now at $100 per ton. And I'll dive into that a bit more as I move forward on the whys. But as you look at the overall pricing mechanism, that's the sub-market for the decant oil, for the ethylene tar relative to the fuel oil. Then you have your freights, whether it's barge or vessel, and those have gone up, at least the larger, longer routes due to other factors of IMO. And I'll again, I have a slide for that. And then you hit your final derived price. So let me move forward. Some of the macroeconomic events that have occurred that are impacting feedstock and where they touch on Asia as well. So just coming into it from a scope and scale mechanism, this presentation will be focusing in on the three to the right, and I have a highlight and breaking that out by country coming up here, but it's roughly a $9 billion industry, and these are at capacity. So one of the things throughout my presentation, I generally focus in on capacity, and for correlations, what I would recommend doing is either working with Paul or working with Paul's latest numbers on utilization to get the actual consumption for a particular region there, or site or country. So this is a bit of what if you look at this map here, it shows on a global basis, what are the overall primary consumed feedstocks? And if we look at, the Asia I have primarily right now is China, but China is a coal tar based region with all of its blast furnace. And we look at some of the trends that have occurred over the longer term. China used to be an exporting region to Southeast Asia, Indonesia, Malaysia, South Korea. That's no longer the case. And that's driven by a lot of the imports coming in from the US Gulf Coast and their economic viability. If we move over to Europe, you have a mixed region where they're consuming all three more or less on an equal basis. And then shifting to the US with its heavy refining base, you have primarily exports of US Gulf Coast decant oil. And you do have some consumption more in the special units of the ethylene residue, ECR, and some coal tar as well, but because it goes into an alternative market in the US, wood treatment and railroad ties and telephone poles. So if we talk about what's changed in the global flows of feedstocks, I would say first and foremost is IMO 2020 increased the cost of shipping because these larger red lines here went from being able to consume 3.5% sulfur to a 0.5. And I actually have a calculation that shows that coming up here. I'll show you that in a minute. But I also think another major disruption, if you're sitting in Thailand, India, Indonesia, Malaysia, other areas consuming feedstock, is typically that was supplied by the top traders coming out of the US Gulf Coast, and they were dealing with a handful of refineries. And one of the primary suppliers there changed their business model in which they work with the market. Typically, they just sold their material to the traders, and the traders moved it to the Southeast Asia. That's changed. That primary refiner has changed its model and shifted towards a direct sales basis, which has thrown a whole wrench into the market on a commercial basis and a model basis that have helped push these premiums of U.S. Gulf Coast decant oil to over $100 a ton. And this one, coming down into the second one here in the bottom of this yellow box, is what's occurred in the past. As prices would come up from the U.S. Gulf Coast, it would push the Chinese material back into the open arbitrage mechanism, and then they would be able to supply into and pick up that business that's being not serviced by the U.S. Gulf Coast. But given the peak of let's call it steel and construction and the ultimate output of coal tar, the Chinese materials are still at a point where the arbitrage is closed for them. So the Southeast Asia, Korea sites are still consuming U.S. Gulf Coast material. Diving just a little bit deeper into one of those other factors, this is IMO. And what I've done a lot of studies and presentations on this, and I tried to take the highlight slide out of it and present it here. Just to give, yes, it is roughly a year ago that it was implemented, but COVID, I think, IMO had a potential for us to be some really painful scenarios in different sites. But then COVID threw a wrench into what was supposed to happen with IMO by destroying demand and shrinking some of those spreads that everyone was forecasting was going to happen between low sulfur and high sulfur. But the point of this slide here is who are the essential winners and losers. It's probably a tough term to use, but the winners and losers of IMO 2020. And it's primarily derived by the emissions profile of your plant. So I did a lot of research and plotted out every single site, what their sulfur permits were, where their feedstock consumption profile was. And for sites that had the ability to use feedstock with generally a 2% or greater, down to about 1.5 or greater percent sulfur, your costs on the carbon black feedstock side went down. If you were in that range of, let's say, 0.8 to 1.2 to 1.5, you were neutral. And if you were less than 0.8, you had an enormous competition for that materials to be blended into that 0.5 pool. So if we look at this on an Asian basis, Japan usually has and you can see this red here, has and South Korea, tight restrictions on the SOx output, and therefore that dictates the input feedstock. They've had increased costs due to IMO 2020. China I put as neutral, and that's primarily driven by it's a coal tar consuming region, and coal tar is not impacted due to IMO 2020 because you can't use it in a bunker market. That's the reason there. Now the winners on a global and Asian basis are Southeast Asia, India, Russia, the United States, Mexico, and northern South America. So now diving a little bit more into the overall consumption of feedstocks. When you look at it's more than 50% of the global market is represented here, this 14 million metric tons out of the 22.6. And you can see the profile on a country by country basis, who is consuming, and it's 2/3 driven by the Chinese market, followed up by India, and India is growing, and then Japan, and down the line you can see there. So now I wanted to touch on sustainable future industry trends and the impact on carbon black feedstock. The first we're hearing about, and it's not the first we're hearing about it, but it's greenhouse gases. And this comes at us in various different mechanisms. If we look at where the focus initially was, and we look at what happened in North America with the EPA, that was a SOx-driven effort. And at the same time, now we're seeing the efforts coming up on other greenhouse gases, whether it's methane, carbon monoxide, carbon dioxide, or the NOx side of things. It's coming. Regulations are impacting that, and what a lot of companies, when you look at, are doing right now is when you look at the feedstocks, each feedstock has its own profile of a greenhouse gas output. And if you look at how a feedstock manager or a site manager or whoever in a carbon black company, how they bought feedstock, it had variables that went in there. It just wasn't a price decision. It was yield, its quality, the value, the overall cost, and its emissions profile. So at this point, now and it used to be that emissions profile was primarily driven by SOx and NOx, because that's what was addressed in the permits. But one of the things I'm doing and looking at is a lot of companies are now saying, what's my overall greenhouse gas output by feedstock type, and then how to optimize that, and how that what type of premium someone's willing to pay for a low greenhouse gas type of the things that are coming about now. And it's not an Asia Pacific specific item, but it is impacting everyone, including Asia Pacific. And I think this is the future of what we see coming at us in the next area relative to feedstocks. And I talked about, and we're just going on a whole sustainability topic here, and IMO 2020. And if you're looking at making your overall supply chains greener and more sustainable, you have to go back and look at this. You can see it in the faded background. I left it in here. These are the long supply chain routes where companies are looking at bringing materials because of structural needs and the lack of feedstocks in their region. So what I thought it would be interesting to do is just point out how much feedstock, or not feedstock, how much bunker, the fuel, and bunker is the fuel used in a ship, how much is consumed just to move those feedstocks. And I took a route example, US Gulf Coast to India. I took a vessel that I see moving out there and went out and did some research and talked to a lot of people and figured out, okay, what's the average fuel consumption on that ship to move the feedstock? Consuming roughly 50 tons a day in pre-IMO of the 3.5% sulfur material at this price. That route takes roughly 40 days. You're using that many tons for the entire voyage. Here's your just a cost perspective of what has had to happen as part of IMO 2020. Now that ship is same ship, same amount of tons, same days, is using a different fuel, 0.5, because of IMO at this current price, January 2021 pricing, and your new cost is here. So to me, I want to point out two factors. One is the differential times 10 is roughly what you have, you're spending in extra cost because of IMO. And then the other factor is, you're just spending to move those feedstocks, $8.5 million a year. So there's quite an incentive, not just from a sustainability factor, but also a cost perspective to work with local sources to identify and develop those localized feedstock sources, like I said. And this starts quite often with a refinery And it goes back to that point on my slide of the overview is it's 0.2% output of a refinery. Quite often it's viewed as a waste and consumed internally. So it's a bit of a development project to identify a refinery, work with the right people, and convince them to invest or change the economic model in which they deal to put that material on the market so that the carbon black industry could consume it, quite often at a premium to what their internal value was. So that's, I think, a future trend and something I'm working on as well. And I think my second to last slide, and hopefully I'm slightly on time here, Martin. But this is another interesting aspect of the circular economy, the green sustainability, all those in one. And this is, Martin's the expert here, and I'm focusing in on the oils. But this industry, to me, is amazes me. I guess I ask colleagues and friends, what percent of your tires that are sitting on your car right now, if you process them in the right way, turn into a diesel-like fuel? And I typically hear 5% or whatnot. And as you can see by this chart here, you can turn your tire roughly into 50% oil, which I think is amazing. Those oils can then be processed and utilized in a mechanism that comes back into the carbon black industry, which is this piece here. And a lot of companies active in that pyrolysis market are working with carbon black manufacturers to qualify their oils, and it's a growing market. There's less than a handful of key pyrolysis plants out there working, but there are a lot of them coming after it and investing money, and the ESG funds and investment monies are flowing in this direction, and I think it's the next big thing coming at us relative to the carbon black aspect, because I'm only focusing here on the oils. Paul and Martin are focused over here on the 30% carbon black that comes out of this. So I think that's interesting and where things are headed on a global basis. So that's the end of my presentation. My goal was to go a bit global, but also focus in on the Asia piece and a lot of the trends and what's happening and how it impacts different regions and trade flows. So hopefully I did that. And Martin and Paul, if you have questions, please fire away.
Great. That was fantastic. Thanks, Shane.
Thank you, Shane.
I do
fantastic presentation.
Do you want to jump in, Martin, or I have a question if not?
After you, Paul.
I just thought the most intriguing aspect of what you were talking about was what feels like a really fundamental and profound shift in the feedstock industry, which is more of these primary refineries becoming directly involved in selling and trading carbon black oil. So I guess it's a twofold question. One is, do the carbon black suppliers themselves have a place in fostering these relationships directly with refineries? And second of all, I guess I would say, do you agree with that this is a fundamental shift in the way that maybe feedstock is delivered from the refinery to the carbon black plant?
Yeah, so to answer your question, I wanted to come back to this slide just to show the value chain. And so, you look at these arrows, right? So some of them I have them going, underneath this layer, and this layer here these are the feedstock traders. These are the guys who are collecting those materials and pulling them all together. And this primarily happens in the U.S. Gulf Coast because of all the FCCs and the overabundance and export market that exists. To me, this layer here provides an absolute service to the industry in terms of making it a more, you're bringing quite often a lot of smaller sources together. You're blending away quality problems and building a mechanism for someone who wants to be a bit more hands-off, almost directly to their door.
Right.
At the same time, when you are one of these, let's say a refinery, and you're supplying an enormous percentage into this layer, the incentive for you to become that layer grows. And when you see that, when this, let's call it this layer here, the feedstock traders layer, is becoming a delivery on a one-to-one basis, it's probably, if you're that refinery, you don't see the value in that middle layer. Now, if that middle layer here, the feedstock traders, are performing all 5 of these steps, it's a whole different picture. But when you see large volumes, and that's essentially what happened, my perception of the event is this refiner just decided, well, we don't see the value that this middle layer is adding. We're going direct. They've done that in the past. One of the things that the benefits, if you look at it from what are the pros and cons of a model shift from a refiner, it's 0.2% of his output. This feedstock trader basis allows him to have a steady state offtake, because the problems that can come out of that dealing direct when you have such a large volume is, if you have a problem with your primary customer and you don't have others develop, you now back up your tanks for your decant oil, and something that's 0.2% of your output can shut down your plant, or not your plant, but really cause problems for you, that if you had someone in the middle, a feedstock trader, they would have multiple routes to move it for you and keep that tank empty. So I think this is a cycle that happens, and right now the conditions and economics are pointing towards it working for the refiner. But quite often, this feedstock trader model layer exists for a reason.
Are there any squeezing points, Shane, that in the service model of the refineries, maybe is scale a squeezing point, that the trader can follow low volume or medium volume demand better than the refinery?
Just so, Martin, so I understand, you were asking, I'm not sure I understood your question. Could you say it again?
Are there any pinching points when the refineries get rid of the trader layer in that value chain? Is there any kind of service they cannot do as well as the trader, because they're set up differently? Their scale is much larger. Maybe they cannot follow individual customer needs because they look at really huge volumes.
I think, to me, what occurred that caused that plus $100 per metric ton premiums is this: in the U.S. Gulf Coast, it's a very specific case of one refinery here going direct to the industry. It can work for that refiner. I mean, it requires them to have a lot of effort, much more communication and interaction with various carbon black plants to make sure that occurs. So if they're willing to put that effort, that team together to support that, it can work for them. And it only works for them because they have the scale. If you're a medium to small size refinery and you want to do export into those markets and you want that steady state, then there's the absolute feed or need, I should say, for the feedstock trader for these services of pulling your material together. And if you look at it, if part of what a service of this layer does is it blends away the quality disparities that happen in a production of a particular refinery. Now, if you're large enough, you generally can get away from those problems. But if you're a smaller refinery and you're outside of a specification for a direct consumption need, having this company here blending it when they're mixing with 3 other refineries can take care of your quality issues that wouldn't allow you to sell direct to a carbon black site. So there's both, I guess there's both sides of the coin. And that's why these lines exist direct, and why these lines here are sometimes through this layer.
Can I ask you a question, Shane? Separate from what you're talking about, the trading issues, can you talk a little bit about the quality issues that hit the industry, especially the decant oil industry this year in particular? Just because I've heard that over and over, that not only were the premium side, but quality has been such an overriding issue for the entire year. And I think that has to do with how FCC units were run and at what utilization and what was the slate of products that they were producing, whether it be, aviation fuel or gasoline or whatever. But it seems to me as though that factor also had a big impact on both availability of decant oil and in particular the quality level.
Yeah, so if you look at decant oil, it comes out of a unit in a refinery called the FCC, the fluidized cat cracker, and some people call that the gasoline producing machine. And it's taking, if you look at a refinery and you say from light ends to heavies, the value follows that line as well. So in general, you want to take your materials that have a value less than crude, convert them to lighter products, which have a value greater than crude. So fuel oil is usually somewhere in the 70 to 90% is a typical range of crude is the price of fuel oil. So if you're a refiner, your goal is to never sit there and sell the material you're producing at less than the raw materials that came in. So that's the function of the FCC. So the FCC takes that heavier material with a value less than crude, and in normal conditions, when gasoline demand is high, it's run as severe as possibly could be to produce as much gasoline. When you're pulling all those light ends off, the heavy material coming out of the bottom is the slurry oil. So the more severe it's run, which means the higher the gasoline demand that's out there, the better the quality of the carbon black feedstock, the decant oil. By that, I mean the heavier. So you're pulling all the light ends off, you're left with the heavier material, higher carbon, which is what the carbon black industry wants. So the quality factors coming out of that are twofold. One is gasoline demand is down, which means it's not being run as severe. So you're not getting as good of the volume plus the density, the quality isn't there, density from a carbon black perspective. And then the second factor, and this is more of a longer term trend, is just in general, the US Gulf Coast and US has shifted towards a lighter overall crude slate with all the shale oil coming in that is much lighter than historical factors of Venezuelan or other heavy, producing crudes that were consumed. Okay. And if you go back over time, just to give you a feel, that the typical decant oil around the world is somewhere that's consumed in the carbon black industry is 107 to 108, 109 if it's good. Historically, the US Gulf Coast decant oil, and I'm saying you go back 10, 15 years ago, it was 1.14, 1.12, which had a yield boost, and it just had a real benefit for the industry. And as shifts in how FCCs have been run and the crude oil slate, US Gulf Coast came down and was on par from a quality perspective to all other decant oils around the world at 108. And now it's even gone lighter with shale and COVID and others, and you're seeing numbers at 106. So I think that's what you might be hearing and feeling, Paul.
Okay, that's great. Thanks.
Yeah.
Thank you, Shane.
All right. Thank you.
Is it my turn?
You're up.
Now on to Martin.
Okay. So I want to present about the South Asian carbon black industry mapping and also about RCB, of course. So first I will do a quick introduction. I will talk about actually how you can look at markets and industries. I will do some slides on industry mapping and segment mapping, and I will give an update about recovered carbon black. So I'm a chemical engineer, studied in the University of Erlangen-Nuremberg in Germany. Started my career actually in the white business, not silica, but titanium dioxide. Worked in plastic colors in master batch, and then finally spent 2 years in carbon black in Europe on the sales side of carbon black. And I have a boutique consultancy, and my specialty really is the marketing of chemicals and especially recovered carbon black. Also do coaching and customer scouting. Now, talking about carbon black customer databases, you can look at the market from top down and from the bottom up. And from the top down, I mean, you can look at country level data. And from the bottom up, you look at customer site level data, and you have the chance of doing a segmentation. I have, you might know, 2 existing products, customer list for carbon black in Europe and North America. Now I'm mapping out the carbon black industry in Asia, and by the way, also Latin America, but that's not the topic of today's webinar. So far, I've mapped out 390 sites in 16 Asian countries, and they're accounting for about 6 million metric tons per year demand. So I am, as everybody else, is using Paul's notch data. So this represents about 67% of the forecast for 2020. And I want to move to a web-based subscription service where people can just log on my web site and select the region, select the country, and they get their industry data on site level and including segments. Now, what Excel allows you to do is actually a mapping on countryside level. Now, I have to note this map and these numbers are capacity based. So they are not really considering the capacity which Paul has presented, but this is just the capacity of the carbon black production and the capacity of the carbon black customers. And very clearly what we can see is we have a big surplus in China. We have a slight spelling mistake. It should be India instead of Japan. We have a surplus in India. We have a slight surplus in Thailand. Australia is a net importer of carbon black. Vietnam was mentioned in Paul's presentation. Vietnam is importing the entire demand of carbon black. Taiwan is importing. Japan, although production is quite high in Japan, is a net importer too. And South Korea is a net exporter based on the capacity. Now we can have a little bit of fun and we can look at site level maps. So this is a map of all carbon black consumers down to 5,000 metric ton demand per year. In most countries, it's difficult to get the map on the screen. We don't show Australia. In Australia, we have mainly demand on the south and the east coast. And we can add to that the carbon black sites. But let's look at a little bit more detail. As we all know, the biggest consumer of carbon black is the tire industry. So these are major tire plants in Asia. Again, not showing the entire map, but there's no tire production in Australia, so we can cut that off. We have also cut off a little bit of Indonesia, Philippines, but we're showing the major countries and the major markets where tires are produced. We can also see density of tire production in India, China, Japan. Now we can add, because we have customer-based data, we can add non-tire rubber companies. And they are added as the orange dots in this map. And we can do the same for the plastic industry. Now the plastic industry and the volume is much smaller. And here I have mapped out the master batch industry, which is perhaps the biggest consumer in the plastic segment. And here we can see there's a lot of plastic master batches in India. In Paul's report, they would be under the specialties segment in the World Carbon Black book. Now we can add the carbon black plants, and generally the carbon black plants tend to be where the oil is, and tend to be where the polymer is, and tend to be close to the tire industry. One thing is interesting, without mapping, I didn't realize that Shaanxi in China is a big center of tire production, also carbon black production. And it looks like a little bit in the middle of nowhere, where most of the tire industry and most of the carbon black is more on the eastern side of China. I think there's a pretty good spread in India of both the carbon black consumers, but also the production. And Japan, there's a notable concentration on the North Island. Now let's look a little bit at recovered carbon black, and we'll continue our mapping in a moment. So just to recall, carbon black comes from end-of-life tire pyrolysis, where generally, depending of course on the feedstock, if you use PCR passenger car radial tires, you might have 10% gas, you might have 45% oil, you might have 12% metal, and you might have about 30% solids. And that solid can be refined to recovered carbon black. Feedstock control is of the essence, and the state of the technology is that every tire going into the pyrolysis is chemically analyzed by TGA and XRD, because only then we can make sure that the output of the pyrolysis is a consistent quality as well. We also need process control for the recovered carbon black. We are especially looking at low volatile level because that means a low level of PAH, polycyclic aromatic hydrocarbons. But we also want a low char, because if we leave the pyrolysis on for too long, we'll have a lot of carbonization of the rubber polymer into carbon. So it is chemical carbon, but it's not carbon black. It doesn't have the correct granulometry that is defining carbon black. We need ultrafine milling. Certainly now the standard is below 10 micron. And we want a pelletized, a granulated product for the ease of dosing, ease of handling, and low dust manipulation of the product, mimicking what all the users are used to from carbon black. There is no quality standards yet by the working group of ASTM D36. So Wolfersdorff Consulting Berlin has created quality categories. RCB 1 is reflecting the state of the technology, the best of the best, so very low PAH content, low char, it's milled, it's pelletized, and certainly it is from a controlled feedstock and a controlled production. RCB2 might be deficient in one or two or more properties, but still a commercial quality, whereas RCB3 is unrefined, raw recovered carbon black, which generally cannot use as an alternative for carbon black. Now, there's a strong interest from major tire makers and the chemical industry. For example, Continental, Michelin, Bridgestone, Pirelli, Hankook, all aiming or are using recovered carbon black. BASF is interested in the pyrolysis oil feedstock. And the problem is there is a limited supply of RCB1 quality. There is a limited number of pyrolysis companies that can produce high quality recovered carbon black, and that has limited so far the production and the scale up. Now let's look at where in Asia the different quality volumes are. There's only, I think there's only one player that has RCB1 quality, and that is Enrestec in Taiwan. And they have a very nice RCB, low volatile, low PAH. And I think that they are the most commercialized one. When we look at RCB2, there is more players in India. There's also players in Vietnam and in Malaysia, in Thailand. RCB3, we have more companies, more players in India. A lot of the Chinese players have big volume, big capacities as typical for China. But to my knowledge, those companies have not focused on the adequate refining. They would call it deep processing of the recovered carbon black. So it is mainly RCB3 type of quality. Now let's look at all together. These are the major carbon black consumers along with producers of RCB of the various quality levels. I think that most of the RCB2 quality producers, they are entirely capable of increasing the quality level to RCB1. So there's a good chance of getting RCB1 quality in India, for example, from a number of players. So that was my presentation. Thank you for listening. And of course, I'm open to questions from you, Paul and Shane, and everybody else offline by email. Just send me an email on this email shown on the screen.
Yeah, great presentation, Martin. I have a question. If you go back to that slide you have here, and it's more about the tire pyrolysis industry as a whole, and this is your area of expertise, but I did a quick count. I think you're in the mid-20s here, and my understanding and past conversations with you is that there's two in North America, one in Europe, and I'm just given that if there's three in the Western Hemisphere and 20 some odd, what's the main difference that causes it to be so much more dominant in this region? versus elsewhere?
Yes, I think what has to be said is that the driver in Asia is economy, whereas the main driver in the Western Hemisphere, in Europe and the States, is ecology. Also, the permits are tougher to get in Europe and in North America, so it's a different scope. And the companies I plotted here are only the top companies that at least look at RCB, that are the most prominent companies in the Asian region. There are many more. There are hundreds more, and many of them are operated in a rookie style and are being shut down by the governments of India and China. So this is really the top of the region, the top players. And Restec recovered carbon black is used in tires, is used in wetsuit production. Indian recovered carbon black also goes into plastics and rubber applications. The many companies that are not plotted, they are in for the oil mainly, and not for the recovered carbon black. They see the raw recovered carbon black as a solid fuel rather than as a functional material.
Okay.
I have a question for you, Martin, or possibly a couple of questions. One was, in terms of delivery to market, you were talking a little bit about the recovered carbon black suppliers. And I just wondered, I know there's been a couple of major announcements in terms of agreements between suppliers of virgin carbon black and recovered carbon black. I'm thinking in particular of Continental's agreement with Boulder, and then Orion's announcement of their sort of very comprehensive program to incorporate more recovered carbon black. I just wondered if you had any thoughts about that, whether that makes sense as a route to market for RCB suppliers. In other words, pairing up with virgin suppliers, or do you see it as an issue of direct sales to? I mean, some of them obviously have also sort of set up their plants in close proximity to a major customer and gone that route. So I just wondered if you had any thoughts about, the development of the RCB industry over the next 5 years. What's the model that makes the most sense in terms of getting up to scale and getting customers as you wait through that period of getting approvals and that sort of thing?
Yeah. As you mentioned, the scale problem, I think, is the biggest problem. And again, we have a different situation in Asia, where a typical pyrolysis company could deliver 10 or even 20,000 tons. In the case of China, 60,000 tons of recovered carbon black. Right. So they go in with the scale. As you know, typical Western companies in Europe or in North America at the moment are at the scale-up level of 1,000 to 3,000 tons. So this is that's a couple of magnitudes smaller.
Right.
And there, the teaming up with a big company makes sense, and the blending with furnace carbon black makes sense in order to grow until the industry has managed to put up production of scale. And then I think it's invisible, because when you scale up at the same time, you have to even more critically control the quality. I think once the scale is there, I see the chance for direct sales, but with the small volume, I think it's very difficult. There's a disparity of the size between the customers and the suppliers of RCB. So I think the partnering with the big companies makes sense to me. Also, the big companies are under high pressure from consumers like ourselves. They need to do something on the green agenda, on the greenhouse gases, as Shane presented, on the amount of recycled materials. And one of the possibilities is to up the amount of recycled materials in the tire by using RCB, for example, in the inner liner, for example, in the sidewall. Again, this goes better in collaboration, because then the small companies find a better route to market.
Yeah, that makes sense, Martin. Well, a question for both of you. How does, which I meant to ask Shane, but how does the oil, the RCB oil, stack up as a potential feedstock? Is that something you can use in a blend with, say, decant oil or coal tar, and in the same way you'd mix RCB into a virgin formula, or how does that work? Or does it function as a feedstock in and of itself? I think it doesn't have the go ahead.
Yeah, there's two answers to that. One is the primary factor is the scale differential. Most of these plants that are doing pyrolysis are, let's say, they're 30,000 tons. So then half of that, 15,000 tons, is the feedstock or oils output. So call it a little more than 1,000 tons a month. And you have a lot of larger or good-sized carbon black plants that are consuming 15 to sometimes 20,000 or more tons a month. So you can generally blend away a lot of the quality issues. But so the answer is yes, you can blend it in. And then if we go back and say, let's look at it just on a standalone basis, if you actually had a high enough volume. In general, what you get coming out of a pyrolysis process, if it's not cut into multiple streams, is a material that's a little too light for the ideal carbon black feedstock. You get
that
about,
was my impression,
you have a specific gravity of about 0.9, where you want a 107, 108 is what you really want. So it just means there's less carbon, which means less yield. There's some other factors. So then what some of the pyrolysis companies, I'm talking to them and helping them with their oils, is it feasible to split it into two streams and call it a light stream and a heavy stream? And then both streams are more ideal for a straight run kind of market, because you can move the heavier material into the carbon black industry, and then you can move the lighter material into a diesel pool. And based on where you are in the world, you can also get a biomass credit, because 25 to 35% of a tire is natural rubber. So based on that qualification, and if you're splitting the pools, you can get a bio credit plus moving it into those two independent markets.
That makes sense.
Absolutely. I think the disparity of the volume, I looked at it when commenting on the black cycle. So when you want to recycle half of the European end-of-life tires, the amount of recovered carbon black you would produce with the black cycle system, in my calculation, was 400,000 tons. But the pyrolysis oil you get, which is suitable as carbon black feedstock, is only a small volume. And then if you add the yield factor, you can have maybe 80,000 tons of sustainable carbon black, which is a furnace carbon black based on pyrolysis oil. So I think that volume will be kind of limited, because you can only take the bottom fraction of the oil.
That makes sense.
Still a very exciting application, I find, because you have much more flexibility of producing hard blacks as well. Anything you want from that kind of feedstock, and not limited to the soft blacks application like recovered carbon black.
Oh, that makes sense. So it lets you go into the hard grades then as well. It makes sense too from a supplier point of view, the supplier here being the carbon black supplier, that it gives you an extra ability to sort of green that process, which is if you're using the oil to make virgin carbon and you're mixing in the RCB, it gives you two options for sort of adding that piece to your manufacturing process, which makes a lot of sense.
Yes.
I mean, given the sort of, what we're talking about, Michelin and Bridgestone, these people announcing very aggressive targets for the amount of sustainable and recoverable materials in their tires over the next 20 years or so. It's definitely the trend the industry's going in. So
I think if you
and they might
go ahead, Martin.
They might lead that development in Asia as well, where I see economy the major driver, and I think these companies, they will bring the ecology to Asia as well.
Mm-hmm.
I just think the overall sentiment on this is growing, and it's not, quite often industry trends are a push or a pull or other things. This is, I think it's on all aspects. You have, the tire side pulling for the recycling of the tires themselves, as well as the consumption of recycled carbon black, and then you have a pull from the chemical industry where they're like the BASF deal where they're pulling in the pyrolysis oil back in as most likely as a naphtha feedstock blend to make that more of a green process. And then you have the carbon black plant and manufacturers who can be seen on both sides, where they can consume the oils, they can blend in the RCB. And I think not only, there is an overall sentiment of it, but there's also an enormous factor, which I think is another key factor to it, is there's a lot of interest in the finance community in these ESG funds, as well as,
impact funds.
Yeah, those are huge. And now you see another trend that's happening, at least more here in North America, is these SPACs, special purpose acquisition companies, that just have enormous pools of money where they can pull in $200 to $400 million, and they look for projects that meet this kind of a profile. And there's one company out there that's announced a linkage to a SPAC with $250 million in funding, and I think the technology and all of the factors are ripe, and now you have a large investment pool being pushed at it. It seems like the way the industry is going.
And we haven't even mentioned like sort of complete alternatives such as the monolith model. And I've heard some other people investigating this sort of alternative feedstocks to carbon black production. So I think there's a third piece in there that is perhaps a topic for a completely separate conversation. But I think that there's a lot going on there in terms of a shift in the entire feedstock slate and how you get carbon black and what the route to carbon black is as we go forward in the next 10, 20 years.
Absolutely, and we're converting our Asian conversation into sustainability. Maybe that's another one.
Everything becomes sustainability nowadays. So yeah,
I mean, you see it everywhere. You see it in the feedstocks. You see it in downstream of the feedstocks as well. You see it there. You see it one step forward in the carbon black. You see it one step forward in the tires, and then it comes back in the full circle. So it's it's there.
Right. That has been a great discussion, Paul and Shane.
Yeah.
I'm happy to be part of it. Thank you. And I hope it's the first of more to come.
Yeah, certainly.
Absolutely. Thank you, Paul. Thank you, Shane.
You want to address questions for if anybody listening, how they can address questions to us? Do they do it individually, or how do you want to do that?
I think I would invite participants of the webinar to either send an email to the relevant presenter or to all of us, and we will answer all email questions within reason. Let's say 3 to 5 questions per email.
Great. Well, I was happy to participate. Thank you so much for setting us up, Martin, and thank you, Shane, for participating. It was great.
Thank you, guys.
Thank you, Paul and Shane. Have a great day.
Bye.
Take care.
Thank you.
Bye.
Thank you for watching Martin and Friends, Carbon Black Asia with Paul Ita from Notch Consulting and Shane Perl from Alpen Group. If you have questions, please send us an email and we will reply. Have a great day.